When we were talking offline before the intro, I said, Rick, how do you want me to introduce you? You said, I don't care about titles. And that's always been your MO. You don't care about titles. You said, I'm an investor and a speculator, just like all the other regular folks out there. So what is one to do in this environment? How does this play out, I guess, is my first question to you. Like, how much more steam does this market have?
That's better than titles. I like this. Now I can do something useful. First of all, you have to do something that seems counterintuitive and that the Fed doesn't want you to do. You have to hold some cash, Daniela. That's critical. Investors don't want to hold cash because they get a negative real yield on it. They feel like their purchasing power is declining. But if you have a circumstance like this, where the market is frothy as a consequence of liquidity and as a consequence of emotion, rather than because of increases in trade or productivity or other reasons, what you have to understand is that there is some real risk of a black swan event or some tightness in liquidity that gives us the circumstance that we experienced in 2008. I'm not saying that next week the market is going to fall by 50% or anything like that. All I'm trying to say is that you have to maintain larger cash balances than many people feel are prudent. When you have cash, in the event of contraction in liquidity, which causes all prices to fall, you have the tool and hopefully the courage to take advantage of it rather than being taken advantage of by it. I also believe that investors, particularly of my age, over 60, need to maintain some of that purchasing power in precious metals for reasons that we can describe later if we want to. I'm not talking about buying gold because the gold price is going to go up. I'm talking about buying gold because gold traditionally has been insurance against the depreciation of the purchasing power of your savings. I'm also saying, by the way, that you don't need to get completely out of the broad market, or if you have courage, even reduce your exposure to the broad market. Well, I suspect that we will, sometime in the next 2 or 3 years, experience a broad-based decline in liquidity, and hence probably a broad-based decline in equity indexes. I'm also of the opinion that 10 years from now or 15 years from now, that a collection of the greatest companies in the United States, represented by the S&P 500, would be higher than it is today. But while everybody talks about 10 years from now or 15 years from now, everybody lives for the next year and a half or 2 years. So maintain some cash, maintain some precious metals.
Okay, let's take that a little further, the cash part. I get the cash part, but if there's a real crisis, a real black swan, we've seen what happened in the Bahamas when Hurricane Dorian hit and people didn't have access to their cash. They couldn't get to the ATMs. It was the impetus which launched them to launch a digital currency. So how do you get access to that cash in a crisis, Rick?
I suspect that many of your more prudent listeners might store some of that cash in the form of, as an example, junk silver or cash that they had immediate access to. I would encourage your younger listeners, Daniela, who do that, to be very cautious about how they store that cash and how many people that they tell that they have access to that cash to. It exposes you to a whole different set of risks. I'm not discouraging what you suggest. I'm just saying beware of the risks of having a lot of liquid assets in your house. Sometimes people come to visit you whom you normally wouldn't have over for lunch.
But it's not necessarily part of the banking system.
I believe that in the near term, 12 to 18 months, that fears of the collapse of the banking system are overblown. I personally believe that confidence in the system, however misplaced it may be, is very high. And what makes the political system and the banking system work is confidence. So in the very near term, in the 12 to 18 month time frame, I think that the amount of cash that you have freely available to you doesn't need to represent anything like a year's worth of survival cash. I think the probabilities of a near-term collapse in the banking system are pretty low, despite the fact that among my own crowd, I may be one of the few who believes that.
So basically, do you think that there's a threat though in this general moves? I mentioned Bahamas. We see Japan with the digital currency, China testing out their digital currency, Europe announcing they want to test one out, and we could see one, within the next decade. Does that pose a major threat to commercial banks?
I don't think it does pose a major threat to commercial banks, because I suspect that the commercial banks are powerful enough economic and political entities that they will cause the emergence of digital fiat currencies to serve their own interest. It was famously said that elections are advanced auctions of stolen property, and the outcome can be determined by looking at the interests of the participants. The banks are very large participants, and my suspicion is that any digital currency that emerges from a large fiat will take into account the interests of the banking community. I wouldn't be overly concerned about the fate of the big banks. They seem to be better able to take care of themselves than we are.
I won't lose sleep overnight thinking and worrying about those commercial banks. I couldn't wait to get you on because I want to get your take on this inflation, deflation debate. We've heard the Fed talk of, yes, we will see pockets of transitory inflation, but it won't be runaway inflation. But I've had guests on that saying inflation is through the roof. And I've had guests on saying, no, we are actually in a deflationary period. Where does Rick Rule fit in this equation?
Lots of arguments for both. The overall economy, I think, is deflationary. We have too much debt. And the way that you normally solve a circumstance where you have too much debt is a default cycle. And defaults are very deflationary. If you take a bunch of money that was lent to somebody, saved by somebody else, and that money goes to money heaven, it's deflationary. The policy response to a default cycle, that is the tendency of society and politicians to postpone a default cycle, is inflationary. So you have arguments on both sides. The idea, Daniela, and it's more important to you as a younger person than to me as an older person, that just as an example, the United States federal government has $28 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities, which is to say Medicare, Medicaid, entitlements. That's extremely deflationary. We have built up a debt, which is a bunch of things. It's a transfer of wealth to old fat guys like me who voted themselves a bunch of services from young people like you who wanted to expect those services in the future. We have also built up a debt that is truly unserviceable. It has to be rolled over. That, on the face of it, is extremely deflationary. I would also point out, however, to your listeners, and I think this is important, that the way we have defined inflation has been fed to us top down by the Fed. And maybe it isn't fraud, but it's misleading. An example would be the Consumer Price Index, the CPI. First of all, it's been adjusted for so-called hedonistic reasons, which is to say, it isn't a quantitative measure, but rather a narrative measure, like everything else that's political. The second thing, and this is astonishing to me, is that the Fed's estimate of the cost of living doesn't include tax. While government expenditures are over 40% of GDP, the idea that your cost of living doesn't include tax,
Crazy.
I suspect, Daniela, that would be okay with you if you didn't have to pay the tax. But given that you do, a calculation of cost of living that doesn't include tax seems very odd to me. I understand that government probably shouldn't be considered to be a consumer good. Unfortunately, it's a good which you are forced to consume and fund. And people, when they are thinking about the impact of their savings and their earned income relative to their purchasing power, need to think about inflation very differently than a slavish reliance on the CPI.